Jonathan Camarda. Good morning, or whenever you may be watching this. So let's get rolling. What are we looking at right now? Well, we're looking at basically a dichotomy between two market environments of the battle between recession and inflation. So a few ratios that I'm looking at, after last week's rate hike and in some of the commentary and such, which some went off the rails. We won't really get into in too much detail here, but just what we're seeing kind of going forward. So a couple ratios that I'm looking at right now are the 20-year treasuries versus the S&P 500. And as you know, treasuries have made a rebound off a horrific year last year. And so that spells more recessionary, right? As money flows go in to fixed income, again, with the bond market sniffing out that rates are going down. And we've seen that across the yield curve, that rates are going down if you look at just at the 10-year. Another ratio that I'm looking at that contrasts that, however, as gold has been going up and we've been utilizing that, especially in active capital preservation. Silver, which is more economically growth-oriented, right? That is more of an industrial metal, has been going up recently versus gold, which isn't generally the case, but we're kind of seeing that. So that, again, a little bit of a contrast with treasuries versus the S&P 500. And on the other hand, with declining rates, still some sniff of inflation, as folks, been discussing as well in all the media outlets. Technologies have been outperforming the general market, more specifically large cap technologies, the big ones, you know the names, and large caps in general, your larger companies, generally over 10 billion and above, depending on everyone's definition, they may vary, but again, outperforming small and mid caps. Again, why is this? Well, another contributing factor is the dollar certainly has been a little bit weaker recently as well. Helps the large caps, also douses some of the inflationary speculation, leads more to the recessionary end as well. So a lot of different things. So at this point, the market keeps climbing this wall of worry, not at a rapid pace, but still many are surprised, economists smarter than myself, at the resiliency, and that's why, again, a lot of the models are still pretty nicely, allocated to equities, like your opportunistic growth and income dividend model, your global macro tactical, your velocity raptors, and again, you have slight, you obviously have some cash positions as well, paying over 4%. There's been a lot of flows there as well. And then you have some of the algorithmic models that are certainly taking advantage of those higher cash positions versus the risky assets. So pretty good mix across the sleeves. Again, as always, talk to your personal wealth advisor as far as the specificity of your risk appetite and how you're allocated. So going forward, it's very interesting. We just had that Fed meeting. I think when you look at equity and bond markets, are they sniffing out that the Fed is done? Again, I'm not calling that, but again, when you start to look at the tea leaves, has that been the last rate hike? I'm not saying that here, except for the fact that there are a lot of signals out there, and a lot of folks, again, smarter than this guy, that are starting to hunt that very thought. And then what does that mean? Hard landing, softer landing? Many feel that we're not even, we're not going to escape this, certainly without a hard landing. And the credit issues, right? We went into infinitum. We won't, thankfully, right? We won't go into the bank details like we had the last two casts. But let me just say this. What's the next shoe to drop? Or have we seen stability, right? SVB was just bought there, it looks like by another bank. And in Europe, there seems to be some tranquility, if you will, after the whole UBS Credit Suisse, forced marriage there. So again, we shall see what this means going forward, or are the regionals really in a lot of trouble? Because here's the deal, and I'll leave on this, the general banking system. Here's the problem, is that when you're getting money market rates the way we are, and banks, you get less just to hold the money, why even leave your money in banks? That's an overall thought process. And then some of the conflicting statements from the Treasury last week, again, what's going to happen as far as insured on the FDIC level. Now, here's the other thing I will say, though. Uninsured FDIC deposits are still 30% higher than insured deposits. So there's a lot of money out there in that murky gray for those keeping score at home. So those are the things we're watching. Again, these different dynamics. Again, we will continue to be eternally vigilant as always. If you ever had any questions, just let us know, and certainly want to make sure on an individual level that you're comfortable with how you're allocated through this very gray environment. But again, contrasting signals, never a dull day. Until next time, again, we appreciate your time, patience, and your trust. Stay frosty. Jonathan Camarda.